Hi guys. Today we will analyze MKS Instruments stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock is a bad performer in the overall market. Both the long and short-term trends are negative. It is better to avoid buying stocks with negative trends. Support level is around $114.50. Next strong support level is around $102. Strong resistance levels are around $146 and $159. Next strong resistance level is around $176. In the last month the stock has been trading between $113.20 and $163.90 range, which is wide. It is currently trading near the lows of this range. The stock has an average volume of 0.7 million. This is not a very liquid stock. The stock has been in a downward trend since April 2021. The stock has been a falling knife since March 29, due to the pending $5 billion cash and equity acquisition of Autotech company, and its ramifications. Be very careful with this stock guys. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 19% per year, for last 5 years. We see that the average profit margin of the stock has been around 16% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 107% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for MKS Instruments Company: bad, average, and good. First scenario. MKS Instruments will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 4%. Future profit margin would be a low, 14%. Future free cash flow to net income rate would be a low, 90%. In this case, the fair value of the stock today would be $100. Second scenario. MKS Instruments will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 5%. Future profit margin would be average, 16%. Future free cash flow to net income rate would be average, 95%. In this case, the fair value of the stock today would be $121. Third scenario. MKS Instruments will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 18%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $145. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 9.9. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For MKS Instruments, analysts forecast growth rate around 4% per year in next 5 years, and future P/E around 10. Again, I will use 3 different scenarios for MKS Instruments Company: bad, average, and good. First scenario. MKS Instruments will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 4%. Future PE would be low, 12. In this case, the fair value of the stock today would be $72. Second scenario. MKS instruments will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 5%. Future PE would be average, 14. In this case, the fair value of the stock today would be $91. Third scenario. MKS instruments will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 16. In this case, the fair value of the stock today would be $113. As you can see, today the stock is fairly valued, $114, if we expect the company's high performance in future. The fundamentals are good. And the stock looks fairly valued at the moment. However, the stock has been a falling knife since March 29, due to the pending $5 billion cash and equity acquisition of Intrinsic company, and its ramifications. I may consider buying the stock, but only when the acquisition is over, and when the stock shows signs of reversal. Company's strengths. MKS Instruments is a leading American supplier of components and subsystems that measure, control, power and monitor critical parameters of semiconductors, and other advanced manufacturing processes. The majority of the company's sales are derived from products sold to semiconductor capital equipment manufacturers, and semiconductor device manufacturers. The company has been able to work around ongoing supply chain constraints, given its more measured exposure to electronic components difficult to source, such as capacitors and resistors, and has resulted in relatively resilient demand for end markets. MKS is also positioned well to take advantage of recent commentary from semiconductor equipment and device manufacturers of higher capital expenditure plans. The company's return on assets of 12% and its profit margin of 19% are amongst the best of the industry. Its return on equity of 20% is comparable to the industry average. Risks. The stock has been a falling knife since March 29, due to the pending $5 billion cash and equity acquisition of Intrinsic company, and its ramifications. Their business seems different from MKSI's core competencies, massively changes the balance sheet, likely changes the EPS growth trajectory, and profitability of the company. Be very careful, guys. Other risks include the semiconductor equipment industry's cyclicality, short lead times, the dynamic nature of changes in semiconductor technology, and intense competition. Sudden capex reductions in wafer fabrication equipment markets, or a loss of a major memory customers. A failure to realize synergies from recent acquisitions could also hurt the stock. Based on estimates for the next 5 years, the company will show a small growth in revenue and earnings per share. The revenue will grow by 4% on average per year. In the coming 5 years, the EPS will grow by 5% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.